Okay, I'm going to start off here. Just welcome you guys again. Thanks again for coming. Always nice to get a good crowd out here. We got a really good set of companies for you guys to be introduced to. I've got a pretty varied bunch here today. I mean, there's sort of both ends of the development scale, which if you know me, if you're a subscriber, you know that's sort of where I tend to play. I mean, I do like the early stage stuff, but I also tend to follow ones through development, sometimes all the way through to production, just depending on how things go and whether a takeover offer shows up or I just think it's got ahead of itself. But I do cover things at both ends of the spectrum, and I have companies representing both of those. I'm just going to do kind of a bit of a jump around here during the first bit of my talk. I mean, the reason why I titled it Focus is because I think we're still in a market where that's really what you need to do. I mean, there seem to be really, to me, there's really a couple of types of companies that are finding a bit of success in this market. Discovery stories, particularly ones that have grade or scale, and ideally both. But those have been able to get some attention. There's a number of companies that have done pretty well in the last month or two, and have managed to sort of withstand a overall fairly crappy market, frankly. And the other ones that aren't, it's not that they're trading great right now, but there's certainly some values to be found in the development stage ones, because as I'll go into, I'm very comfortable with base metals, and there are a couple of developers here on the base metal side that are basically both of which are on the cusp of putting out their first economic studies. And I'm quite comfortable those studies are going to be good, but I'm also comfortable we're going to see continued M&A activity. I mean, really so far this year, most metals haven't had a great year. Base metals, I think we've seen a bounce that's real. What's holding back gold, it's partially the US dollar, but really the US dollar hasn't done anything that impressive, and I think it may have actually topped last month. But really, we're just total risk on party mode on Wall Street right now. And when the market's like that on Wall Street, generally speaking, I mean, one of several reasons why people buy gold, be it bullion or buy it in the futures market, is because they're using it as an insurance trade. And there's really nobody that wants or feels like they need insurance right now. It's pretty party hardy on Wall Street. Anyone that's been through as many cycles as I have will tell you that when Wall Street gets that way, almost always the fates will find a way to slap it upside the head. So I'm sure there's probably something coming. I would note that the one thing that we all know is coming in about 5 weeks now is the US midterm elections, and I have no idea. I mean, certainly 2006, that election turned out differently than a lot of people expected, and the market reaction to that election was a lot different than everybody expected. So I'm not sure what to think, other than to say that I think heading into that, we're probably going to see more volatility, and generally speaking, higher equity volatility is usually good for the gold market. If Wall Street has kind of a crappy month or two, that's actually going to help the gold side. Outside of that, I don't see a lot of obvious catalysts for gold to go zooming higher, although I think it may have bottomed, but I wouldn't say I've got high expectations, and that's part of the reason why I'm focusing on discovery plays. If you look at the broader commodity index, this includes base metals, but this particular index, which is the Goldman Sachs, that's been around forever, it's fairly heavily oil weighted. So I'd have to say that when you're looking at this index, keep in mind that part of the reason why it has had this move up in the last little while is that oil itself has actually had a fairly good move here in the last 2 or 3 months. But it's not just oil. Base metals, I think, probably bottomed out 2 or 3 weeks ago. A lot of the move in base metals, to my mind, was political. Like, pure and simple, it was politics. If we look at zinc first, there is, it's not a secret that there are a couple of reasonably large zinc deposits coming on stream, although they're not coming quite as fast as they were supposed to. But that said, there's no imminent oversupply by any stretch of the imagination. Things always go wrong when mines are going into development, and there are a couple of operations that I suspect are going to rack up lower production than people thought they were going to. I'm not really concerned at all about any kind of really imminent supply push or this huge amount of stuff coming into the market all of a sudden. If you look at the right chart, that's the That's the LME inventories, and it's the same story in Shanghai. If anything, Shanghai, the inventories have actually fallen further. You saw this big run up early this year, about 6 months ago, and that's what kind of freaked everybody out, and that's when the zinc price fell out of bed a little bit. But you'll notice that there's a fairly good move here in the last couple of weeks. And unfortunately, Kitco's charts are always 24 hours old for some reason. Zinc's actually 4 or 5 cents a pound. So basically, the zinc chart, if you look at the end, it's actually moved up. It's almost about literally right now, it's closer to about $1.20. And you can see on the right side of the chart how much you can see how much the supplies come off. Like, yes, we're not down at sort of this area where we were at the start of the year, where the zinc price is going crazy, but we've had pretty much daily drawdowns in zinc. No obvious expectation that we're going to see a big bump up in the short term. A lot of this price move, and this is true of all base metals, a lot of that is political. It's all about the trade wars. People freaked out when all the tariff stuff started, the disagreements, and I don't expect those disagreements to go away anytime soon between China and the U.S. And it's only really been in the last couple of weeks that when the tariffs were hugely expanded by the U.S. and then expanded by China, much to everyone's surprise, there was no drop in base metal prices that day. In fact, copper had a huge day the day those tariffs were announced. I think that was a bottom being put in, partially because people were looking at, you look at these movements, but also when you look at things like the pricing of these metals in China. There's quite a large premium, like there's a big premium in the copper market in China right now. There's a lot of coppers getting sucked into that market because it's worth it for the traders to do it. They can actually roll the stuff over and make 7 or 8% just on the premium. I mean, usually when you see that situation, it's because the smelters are having trouble getting their hands on this stuff. So I mean, the whole, oh my God, we're all going to die because of tariffs. It really doesn't impact that much, and it's worth remembering that copper and definitely zinc, I mean, they're really, as much as anything, they're infrastructure metals. So yeah, China is and has been for a long time the biggest user of both those metals. But by and large, they're not importing those concentrates to produce copper and zinc and make widgets and export it. I mean, some of it gets exported, but a lot of that stuff gets consumed in China. So the fact that there's this tariff war going on between the US and China really doesn't make any difference to the demand, as you can see. It's just taken the market a few months to get past being freaked out by the tariff wars. I mean, that's zinc. Copper, pretty much the same story. And if anything, you're seeing even more of a drawdown. The drawdown's been even more extreme on the inventory side in Shanghai. You didn't see a bounce until this, but I mean, I wouldn't be shocked, unless the world economy falls out of bed, I wouldn't be that surprised if we see copper back above $3 again in relatively short order. And the medium-term supply demand picture for copper is very positive. It's not going to happen overnight, but over the next 2 or 3 years, you're going to see a widening supply gap. And 4 or 5 years out, the copper price is likely to be very strong, because I do not know where we're going to find enough copper to fill the anticipated demand in the next 4 or 5 years. It's a big market. You need to build 2 or 3 literally world-class mines a year to be able to supply the gap that's coming, and there's simply not that many of these things coming. That's the backdrop. It doesn't really get picked up so much on the retail side, but it certainly does on the industry side. And I think part of the reason why you're seeing continued and in fact strengthening, in my opinion, merger and acquisition activity in the last few months is, the demand hasn't gone away. The majors still need deposits. Good deposits are hard to find. Good deposits are a very saleable commodity and always will be. Not so much the same story for gold, unfortunately. The gold chart on the left side is, well, pretty ugly, let's be honest. We did have a bottom, hopefully, put in August, but is that the bottom? Most of the TA, I'm not a chart guy, most of the TA guys I know don't think so. They think there's probably still one more dump to the 1160 range. I don't really have a strong opinion on it, other than to say, to me, the dollar does look like it's topping. I think one thing to really keep a close eye on in the next week, next Friday actually, the next U.S. non-farm payrolls report. I always look at these every month, and I'm not even really looking at the payroll number. It'll be good. It's good every month. No news there. What I usually look at, the first thing I look at in the payroll report is what are the non-supervisory hourly wage gains. One of the big conundrums about the U.S. economy for the last 10 years is it's had fairly strong growth. They have very, very low unemployment in the U.S. and in Canada, but you haven't seen this translating into wage gains. And people keep calling for there's going to be this big inflation push, which there may be and should be at some point in the cycle. I don't think we see that until we see that wage move. There was a fairly good wage gain last month. If there's another good one this month, that might be a short-term problem for the gold market, because I think what you would see is bond yields go up. There would be an expectation that maybe the Fed's going to try to squeeze another rate increase in. But ultimately, if the inflation starts creeping higher, that's a positive for gold, because right now what's really killing the gold market is positive real interest rates. If we get to the point where the inflation starts moving enough that the Fed's unwilling or unable to stay ahead of it, that's when you shift back into negative real interest rates, that is after inflation. That's traditionally, historically, pretty much 100% of the time a great environment for gold, but also for commodities in general. So I'm hoping we shift. I was hoping we were going to shift into that by this point, but we haven't yet. We still really haven't seen a big inflation move. But the other thing that's going to help, ironically, that's probably going to help inflation next little while. You take a look at this very long-term chart here. This is just the percentage of U.S. imports that have got tariffs against them, and in this case, they're 10. And if the argument isn't resolved by January, and it probably won't be, I suspect, it'll go to 25%. But you can see how much tariff increase we had there. And weirdly, when guys in Washington talk about this trade war, I mean, they're talking about charging China to do all these imports, which of course says something about how much a certain fellow named Donald understands about economics, or for that matter, tariffs, because that's not actually how they work. Tariffs are, of course, paid by the importer, not by the exporter. They are, in effect, a tax. And at some point, you're either going to see margin squeeze or you're going to see some price increases because of those tariffs. So this trade war may actually help, if that's the right word, help us start seeing a bit of an inflation ramp that would actually be positive for commodities. The other thing, and like I mentioned at the start, that the other thing that might help, if that's where on the gold side, would be a little bit of weakness in Wall Street. There's certainly no current visibility on any weakness in Wall Street. It's just up every day. But I thought this chart was interesting, and I don't know whether this relates to this, but basically what those green bars are is that these are quarterly, and they're pre-announcements. Like generally a week, 2 weeks before earnings, companies on Wall Street will generally put out a pre-announcement saying, like, steady as she goes, or we think our numbers are going to be better, or we think they're going to be worse. I mean, almost always they say they're going to be better. I mean, they massage the numbers so they can do that. I mean, it's a well-known game on the accounting business. But interestingly enough, this quarter, the positive pre-announcements has really fallen off a cliff, and that might be the tariffs or something, but that might be a bit of a hint that we could have a little bit of rough seas ahead on Wall Street, which is fine for our part of our little corner of the market. I'm not expecting like a crash or anything like that, but I think things might get a little sketchy on Wall Street, which is actually going to help us. And again, the one thing that these charts just allude to what I was talking about, wage increases. You can see just in the last month there was a bit of a tick up in the wages, and really we had this boost that was largely based on this, but also on comments from the Fed that there's going to be another rate increase towards the end of the year. Some fairly positive economic readings in the U.S. That's basically got bond traders bidding up the yields. It dipped back. This is basically 3% on the 10-year. You can take this with a grain of salt, but I think it's a commonly held view on Wall Street that 3.1, 3.15, that's probably as far as this goes without really starting to pressure stocks. So we're not really that far from that, and that's the other reason why you want to keep an eye on things like the next payroll report. I mean, if we see this pop up another 15 or 20 basis points, I don't think Wall Street would be happy. It's pretty close to. It's probably pretty close to the breaking point given the valuation levels. And basically, precious metals aren't helping us. I think base metals are coming back. I mean, gold, any number of things can give us a better gold market. There's all kinds of political stuff going on in the next month or two. But I think it's simpler to just say, okay, let's assume when we're looking at deals and we're looking at companies, let's just assume these things aren't going to go anywhere. I'm pretty comfortable base metals are going to go up, but again, the simplest way to sort of treat this is to just say these things aren't going to do anything. So let's look at companies and not assume that we're going to have these tailwinds all the time. So what's going to help us in that environment? What's going to work in that environment? One thing that helps us, and again, if we see some weakness in the general market, everybody hates the mining sector. They have for years. The valuations are terrible in most of these companies. That's actually a good thing. We're probably about the only sector in the entire market, really, that isn't overvalued right now. And there is a lot of speculative money and things. One other thing I would mention as a potential near-term catalyst is just simply money flows. I really expect before the end of next month, because we'll get past the official date when the legalization date and stuff, you'll probably see flows back out of cannabis again. Everything I'm looking at in that market reminds me so much of the top on cryptos, the top on internet stocks. Take your pick, any number of bubbles. It has precisely the same feel. So I think you're probably going to see a lot of weed stocks get taken apart in the next month or two. And that'll probably move some money back in our direction. The other thing that will help, it's already helped some, it's already helped the shareholders of those companies. There's actually been several fairly big M&A transactions. Some of these are still in the process, aren't even completed yet. There's Arizona Mining, Tukey, Nevsun, Tukey. You come up a lot. The Barrick merger, like all of those things, one of the things those will do is they redistribute a lot of money, but one issue the sector's had, and it's probably affected sort of development level and up companies more, is you talk to guys in most of the finance centers, especially Toronto, you talk to guys running gold funds, and they simply haven't had any liquidity for the last couple of years. I mean, they probably had deals they wanted to buy, but they just simply had no money in the fund. So that's been an issue all along for those guys. But you see this kind of M&A activity, and it basically reloads a lot of these funds. And it's not to say they're going to turn around and buy stuff tomorrow, but I think there's probably room for more, better, larger financings down the road thanks to this M&A activity. And it certainly has a more direct impact on small shareholders and retail shareholders, where you get a nice out, you get a nice price. Your last experience was good with this stuff, you go looking for the next one. I do think that's going to help. And a lot of those things are just really closing now. I mean, Nevsun won't close for a couple of months. So basically, what was working before, it's still the stuff that's working. I mean, high impact exploration stories, I've always had a soft spot for those big targets, early stage. You're going to be hearing from a couple of them here, well, 3 of them actually, in this group. Basically, I like to see big target scale. I like to see something where if it works, the potential value of the project is very high. That's what really gives you the gearing. That's what gives you the leverage. You have to know how to trade these things. I talk about that a lot in my newsletter. Obviously, being in the right jurisdiction is important. Most of the stuff I follow is in places where I'm comfortable. Permitting is not going to be impossible or a particularly big issue. And I think, where possible, if I'm looking farther down the road, more development level stuff, for me, I mean, size is nice. It's great to have a really big deposit, but I think mining companies who are the ultimate buyers of most of these are and should have been all along, honestly, much more focused on margin. The projects that look like they can generate margin, that clearly look like they're going to come in as lowest quartile cost, those are the ones getting taken out. And I think if anything, that trend is just going to strengthen. So even early stage, when you're looking at these things fairly early, you try to get a feel for can this be at least a bottom, the bottom 50% on the cost curve. Ideally, can it be the bottom quartile on the cost curve? Because that stuff's always going to go first. The days of mining companies going, I just want to buy 20 million ounces. I don't care whether they make sense at $1,000 an ounce or not. Those days are over. None of those guys are buying that kind of stuff anymore. They never should have bought it in the first place, in my opinion. And that's it for me. So I am going to introduce the first company. I'm doing them in the order that they're in the agenda, of course.